Hi, I'm Andy Myers in for Claus Vogt with Money and Markets TV. In looking at the U.S. stock market environment, we see several troubling signs. Interest rates have been rising since last August. Energy and food prices are sharply higher as well. The U.S. housing market is weak and getting weaker, and the labor market is still in dire straits. Plus, it's clear that the equity market is severely overvalued and overbought. In short, stocks are a very risky play, and we believe a bear market is right around the corner. Claus has been making this argument for quite a while, but now three new developments are strengthening the case for an impending bear market. First, QE2 will soon be history, and QE3 is becoming more and more unlikely. You may remember Fed Chairman Ben Bernanke bragging about how his program of quantitative easing boosted the stock market, especially small caps. We agree, the rally in stocks since last summer is indeed the result of Fed printing money and encouraging more risk-taking and speculation. But he is dead wrong in thinking that this development is a good thing. Gains that are bought and paid for by the Fed's funny money are nothing more than a speculative bubble, which is bound to burst, just like tech stocks in the late 1990s or housing in the mid-2000s. As long as Bernanke keeps the money flowing, this aspect may be papered over. But now, various Fed officials have stepped up and spoken out against an additional round of quantitative easing. So when QE2 has run its course and hopes for QE3 vanish, there will be nothing left to support this overvalued stock market. Second, inflation is on the rise. Outside the U.S., inflation is actually old news. It has been obvious for quite some time that inflation is the consequence of reckless monetary and fiscal policy. But now it's also becoming more obvious in the U.S. as well. As usual, producer prices are the first to feel the heat of rising price pressures. But consumer prices are sure to follow. And that's a very dangerous development for the stock market, because history shows that stocks perform very poorly during times of rising inflation. A fast increase in inflation expectations has triggered some of the worst bear markets in history, especially when stocks were overvalued. If this relationship holds, U.S. stocks will soon be in for a nasty surprise. Third, consumer sentiment is plunging. The University of Michigan's monthly index fell by 10 points in March. A decline like that is very rare, and when it happens, it sends a message: look out below. Over the past 2 decades, the Consumer Sentiment Index has fallen that fast only a few times. In August of 1990, September of 2001, and October of 2008. All three of those declines were associated with recessions and represented sell signals for the stock market. There was one more huge drop in the Consumer Sentiment Index during that time, in September of 2005 when Hurricane Katrina hit U.S. shores. But we see that external event as the exception to the rule. So with all the signals now pointing to an impending bear market, what should you do to protect yourself? We recommend caution and some insurance in the form of inverse ETFs, such as the ProShares Short Small Cap 600, ticker symbol SBB. This fund is designed to rise in value when the S&P Small Cap 600 index declines. And right now, it's an attractive buy at around $27. I'm Andy Myers in for Claus Vogt. Thanks for watching Money and Markets TV.